now actually record today. Welcome to Fridays for Future, climate-related financial risk. Lucas Mansberger, the floor is yours.
Well, thank you very much, Denise. I chuckled when you called me famous. I'm sure there's no one right now in climate circles in Michigan who's more famous than you, Denise. But I have to say, today I'm very pleased to be here. There are a lot of familiar faces and folks that I know from just seeing your faces, not having chatted with you. So it's a pleasure to be with you. I have to say I'm pretty intimidated today for two reasons. The first one was I had no idea you were such an upbeat crowd. So I feel like I'm going to have to get really cheery here. But then the second reason is I'm a finance guy, an investment guy. But of course, this treats upon some climate science. I'm terrified that one of the experts in the room is going to tell me just how wrong I've gotten something here. So please be kind to me and wait until everyone's gone to tell me how wrong I've got it. So with that in mind, I'll try sharing my deck and we'll see if it works. And you know, if you do have it's customary for you to leave your questions to the end, it sounds like, but if you have something that's really pressing or if there's an issue, please shout out and stop me. So let's see here. I think this will be my first time using presentation format in Zoom, so let's give it a go. Let's see. All right. Can you see the presentation in presentation format?
Looks great.
Wonderful. So here's what we're going to do today. We're going to, it's three parts really. We're going to go through and understand the basics of climate-related financial risk. Where we'll do a little bit of an overview of some of the client science that just backs the assessment of climate risks. We're going to talk about the recent executive order coming from the president on May 20th. And then at the very end, we'll talk a little bit about things that you can do if you would like to invest more sustainably. And that's things you can do either as an investor or as a fiduciary for other folks' investment assets. Just so it's clear, I have a number of slides in this presentation that are dense with information. They're there for informational purposes only. I'll route the deck afterwards for your perusal. So climate-related financial risks. Where do we begin when trying to define and assess climate-related financial risk? In one way, it's painfully obvious. It's financial risk related to the changing climate. But to answer the question of what risks we are running, we need to project the future state of the world. What's actually happening to the climate? And what is that going to do to financial assets? So how do we answer that question? The way we answer all the questions about our future climate with in crazy detailed modeling. And so I'm sure many of you have heard about integrated assessment models. And it's kind of funny. I haven't spent time, I didn't take Dr. Keel's classes at Western. So I haven't spent a good deal of time in my life digging into these models, just a handful of times. But every time I do, I have a very unusual experience. I simultaneously feel energized and inspired by the complexity of the models and the beautiful collaborative efforts of the teams of researchers across the globe who construct them. But I also feel like the dumbest person on the planet. They are so complex and you have to have so much background knowledge to understand them fully. And if you have a chance, dig into them. They're really fascinating, but you may not come out whole afterwards. But these models combine energy system models, economic system models, and climate science models to try to determine what's going to happen to our economy and to our world as the climate warms. So traditionally, those models have been used to answer that question. Given a target of a certain amount of global warming, what is the pathway our economy, energy systems, and planet can take to get there, to that amount of warming? And one of the primary outputs of these models is a pathway for greenhouse gas emissions over the projection period. So this is everyone's seen this before. These are the four representative climate pathways that are commonly used by modelers to show different scenarios for the future for climate modeling. And you can see on this page, they've got the four scenarios, but the bands around these different scenarios show all the different scenarios of different models that were run using the same end warming target. And they show here the greenhouse gas emission bands over these time frames. And some of the common features of these pathways, with the exception of RCP 8.5, which is really close to a worst case scenario. They used to call it business as usual if we didn't mitigate anything. It's really considered the worst case scenario. With the exception of that scenario, all the others peak, the emissions peak sometime usually between 2030, 2050, and then decline for the rest of the way. And how does that happen? Well, the biggest things, of course, are the mitigation of greenhouse gas emissions, a transition from a carbon-based economy, fossil fuels, to low carbon sources of fuel. And each of these models has is a bit of a plug where we invest in carbon capture and storage using technology that we have not yet developed and won't know if it'll work. But importantly, not only do these models include those significant mitigation efforts, they include significant adaptation measures as well. And both the mitigation measures and adaptation measures are very, very costly.
Hey, Lucas, I need to interrupt for just a second. I want to let you know that we can see your presentation mode and we see your notes.
Ah, okay.
So I don't want to mess you up if you only have one screen. I've had that happen before. If you're only sharing one screen, you either get to let all of us see your notes. So you can also see your notes, or if you want to switch to just display so that we can just see the slide, you may want to do that.
Yep, let me go.
I thought I would let you know. The notes are great. It's like closed caption.
Yeah.
At the same time.
Well, I'll be careful. I might have some secret jokes to myself there. Let's see. Let's try this one.
If you want to change it or not, it's fine, because I think we'll get the slides from you after as well. Oh, that's much better. Yes. Yep. Thank you. Wonderful. I'm glad I butted in. Sorry.
Yes, thank you. That's very helpful. I'm glad. I think I do have some things I would have rather you didn't see, so that's great. Let's see here then. So again, the whole point is each of these scenarios includes significant mitigation and significant adaptation efforts. And this, of course, is just to show the two tail scenarios, or the 2.6, RCP 2.6 versus RCP 8.5, and the projected warming of the planet. Now, this is a little bit stale, as folks who are in the know might know. This is from 2014, basically. And there's a whole new set of scenarios that are being modeled, and the paper is expected to come out October of this year, using a different methodology, a different lens. So keep your eyes peeled for that. But the current estimates are that on our current path, before our pledges, we're looking at about 2.9 degrees warming. So that's the baseline now. This shows you the long and short of it. All of those scenarios, again, assume that we move from a baseline of around 22% low carbon energy sources, and these different colors are those four different scenarios, up to, by 2100, somewhere between 70 to 95% of our energy coming from low carbon energy sources. Obviously, that will take a lot of work and a lot of investment. Morgan Stanley estimated a year and a half ago that that'll take 50 trillion by 2050 to get us prepped for a 2-degree scenario. There's a lot of different estimates out there, but that's just one of them, and they're all sky high like that. And I broke out some of the numbers underlying it. Again, you can see it goes all the way from renewable energy generation to hydrogen generation, but also that CCS, the carbon capture and storage, which again, we still don't know how we're going to do that. And adaptation, of course, is going to be costly as well. This is just a sign, another graph showing global grain yields. And so if you focus on that very last box there, that says 2090 to 2109, that shows of all the scenarios that projected broad grain yields out to that time frame, about 22%, those bluish bars, show that there'll be potentially an increase in yields, whereas nearly 80% of all the models and all the projections project a decrease in yields from today's levels, from 2019 or 2014 levels, I believe. I don't remember the date, but basically from today's levels. And you can see that some of them project anywhere from 25 to 100% decrease in yield. And so how are we going to feed more people with less food? We're going to have to find new food sources and drastically reform our food systems the world over. That's, again, costly. And then just another example of the different kinds of adaptations we're going to have to do. You can see on the left various physical effects of climate change and the hazards that occur that threaten humans. And this is just an example of nature-based solutions that can be employed to adapt. But again, they're costly. All right, so that's it. Basically, we're looking at a future where the planet is assuredly getting warmer, and there will be significant physical impacts. We are also moving towards a planet where there's growing momentum on attempts to mitigate some of the worst effects of climate change. But regardless of what we do, there will be significant adaptation efforts. So when you put those trillions of dollars in here and a need to change so many of our human systems, it results in a really dynamic economy, a really dynamic economy. But you really break it down very simply into two sets of risks when we're talking about climate risks. One are the physical risks, and they're categorized as acute and chronic. We'll talk about that a little bit more in a second. And then there's what are commonly called the transition risks. And these are all of those mitigation and adaptation efforts, all the changes that are going to occur to get us to that future. And they include the categories that you see there: policy and legal, technology changes, market, and reputational risks. And this is mostly focused on, this is how they define it for, mostly for companies. You probably wouldn't find quite this definition when talking about the government's financial risks, for instance. So what are these specifically? Here are those physical risks. Acute means the increased severity of discrete extreme weather events such as cyclones and floods. And on the right-hand side, you can see just examples of the types of impacts those can have on companies. The one that's most obvious is the write-offs and early retirement of existing assets. So something gets so damaged, you have to give it up. And then there's chronic physical risks. And those are just those gradual changes that we're seeing here at home, changes in precipitation patterns and rising temperatures. And that causes all sorts of difficulties for built infrastructure in particular. But what about these transition risks? So these four categories, the one on the top, policy and legal. And these are obviously all those risks that occur as a result of changes in the policy environment or law that that pose risks to the value of your financial assets. And I find this one really interesting: exposure to litigation and mandates on and regulation of existing products and services. We're going to talk in a second about what just happened to Shell, which was really interesting. But you look across the board, it's really happening to oil companies in a pretty harsh way right now, that they're reckoning with these things. And then there's these other categories: technology, market, and reputation. And I do find reputation to be very interesting as well. It's been remarkable to me to see how over just a few short years, seemingly, public appetite has really changed. People that I speak to, who I think 5-10 years ago were skeptical about climate change at all, are now all getting on the bandwagon and talking down about bad actors and wanting to make changes in their own lives. So it's really affecting the outlook for companies that are not climate friendly. And then this market one is very interesting as well. This was always something that until recently was more theoretical than actual. But as you can see, changing customer behavior, if you see the polls, so many people now are going vegetarian, for instance. Particularly younger folks, but folks across the age spectrum. And companies like Beyond Meat had a record stock price performance. So there's a great deal of demand for these options. Tyson Foods is moving aggressively into plant-based meats. So there really is changing consumer behavior, and virtually all of the major, certainly consumer-facing public corporations are responding very handily. And that actually speaks to this. This is the climate opportunities side. We talk a lot about these risks, but there's all sorts of opportunities as a result of these changes. And that talking about markets, access to new markets, you see their resilience, participation in renewable energy programs, reducing your reliance upon fossil fuels before the regulation comes into effect. So when we talk about climate risks, certainly a lot of folks who have been working in sustainability for a long time, they're just accustomed to talking about how incredible the investment opportunities and business opportunities are around climate and these significant changes. So, so which companies are subject to climate risk or more subject to it? Well, the simple answer is just about all of them, you know. And this is an analysis by SASB, where they show that of their 77 industries that they categorize companies into, 68 of them have meaningful, or they would say material, climate risks. And that's 89% of the global market cap for large cap securities, which is 45 trillion of assets of equity market value. And this is a neat one. So climate risk exposure by industry, this drills down further so you can get a better sense of the kind of risks that are posed by different industries. Where the color here is darker, that's where it's more exposed to that risk, or considered to be exposed to material risk. And I highlighted extractives and mineral processing. This is pretty obvious. They're subject to physical and transition risk. In this case, SASB breaks out regulatory risk separately, but you can clearly see that for this category, all of these companies are exposed to these risks. Similarly, their infrastructure, most of categories they're exposed to all types of climate-related risks. And those are, you can see easily why. There's real estate, water utilities and services, electric utilities, and power generators. And that's just for your reference, the rest of the sectors there. But you can see that I found, when I think about this classification, I found transportation and technology pretty interesting. Technology is subject to, in particular, some of those constraints on batteries or rare earth materials. So they do have some exposure to these physical risks, as well as intensive resource use, but they're not subject to regulatory issues. And vice versa, all these transportation stocks, there'll be a lot of changes coming down with respect to fossil fuels, having to make you basically buy a new fleet. So a pretty big risk there, amongst others. Now, most of us are not looking at an industry or sector by sector basis. Most of my day job, a third of it, is evaluating investment funds and investment managers. And so this is a way that you might get to see how different the risks that different funds run with respect to climate. So here I highlighted a few things here. These 4 sectors here are those that are tied to those 4 sectors or the 2 yellow box sectors that I highlighted in the past page. So those that are exposed to a wide number of material climate risks. And you can see on the left there, the iShares S&P 500 Value Fund. That's a value style fund, a fund that invests in companies that are considered to have low prices. Maybe they're companies that are a little out of favor. They have lower growth rates, but they might still be somewhat profitable, but just out of favor. Whereas the growth side there invests in all those darlings that we know these days, Amazon, Facebook, Google, faster growing companies that are often asset light, don't have a lot of physical infrastructure, but can often be quite pricey. But you see here inherently, 18% of the value fund is exposed to these higher risk sectors, whereas only 3.5% of that growth fund is exposed to those sectors. And you go down the list, you can see there's fewer fossil fuel stocks in the growth fund. The carbon footprint and the carbon intensity is lower. And then it also has a higher percentage exposure to stocks in the clean 200, which are 200 stocks that are tied to clean energy and new economy activities. So you can see this is just the benchmark type funds, they're index funds. If you employ active managers, they often have very differing risks as well. But these funds can look very different and be very exposed in different ways to climate-related risks. So now this is fun, and I'm not sure when this came out. I got really excited, and I looked around. I went to my colleagues. I went put stuff on Facebook, and I began to feel like I was the only person in the world who was so excited about this, but it's pretty momentous, I think. But before we talk about that specifically, it's really important to note that in the last year or so, really there's been a significant sea change. It had been slowly building in financial services and in corporate America over the last several years, but things really did change in the last year. And what are some of the watershed events that show that that's really the case? Well, the first one is the investment managers are taking climate risk seriously. And the poster child for this is the CEO of BlackRock, Larry Fink, who has gotten a lot of flack, but also a lot of attention and love for loudly trumpeting and championing sustainable investing, and in particular, talking about climate risk as a very significant risk. And so January this year, every year he sends a letter to his investors and to the CEOs in which BlackRock invests. And he tells them what's on BlackRock's mind, what they're going to prioritize that year, their thoughts about the state of the world. And this year he told the CEOs that it's time for them to target net zero carbon emissions. And if they don't act on the climate, BlackRock will vote against the folks in the boardroom, the board directors, when they have the opportunity to. And this year they had the opportunity to. So that happened just a week and a half ago, 2 weeks ago, May 26th, an historic day for climate accountability. And again, this was one of those days you just couldn't believe it was happening. So ExxonMobil lost a proxy fight with an activist investor who was focused on climate and focused on Exxon's being delinquent in addressing climate risks. And so shareholders voted in the two board members they wanted who are intensely climate focused. Chevron investors fought management and forced the company to, are going to have resolved to make the company cut its scope 3 emissions. And then in a Dutch court, Shell was ordered to cut their emissions across the board by 45%. So it was really an unbelievable day, but a sign of where things are headed in the boardroom here. And I think we'll see more of that. But there was one other thing that happened, again, just 2-3 weeks ago, that was very momentous. And it was this guy. So, you know, I'm not, in this crowd, I can allow myself to be a little more direct about my political leanings. You know, Joe Biden was never very jazzed about him. I didn't expect much from him on the climate, and it's still early, of course, but a lot of signs are that he's taking climate risk seriously, the climate crisis seriously, and they're doing what they can to have a very aggressive U.S. response to climate change. And this order was a great example of this. So this order, Executive Order 14030, called for a comprehensive government-wide strategy on climate-related financial risk. And these are the extremely condensed 4 basic big takeaways from this executive order. The first one is White House policymakers will create a plan for assessing climate-related financial risks to government programs and assets, as well as a plan for our economy to reach net zero emissions by 2050. And they're doing that with a 1.5 degree warming target. So they're acting very aggressively, trying to aim for what is the right target. The second one is financial regulators will undertake coordinated, comprehensive efforts to understand and address climate-related financial risks in the US. So this is also very notable, just like I was talking about in the boardroom, how investors are now seriously addressing climate risk through these proxy fights. This will mean that companies are forced to disclose much more about their the climate risks that they face. They're going to have to disclose their carbon footprints, and there's a host of other things that they'll have to disclose, as well as new requirements they'll have to meet around climate risk mitigation. And it's a big deal. It's a big deal. The third one, retirement plan regulators must assess threats that climate risk may pose to our retirement plan savings. This is a fun one, and this is also a geeky one for me. So one of the things was that the federal government's retirement plan, the thrift plan, which is over $1 trillion, that plan now has to basically say how it addresses sustainability factors. But more important than that, the regulators are going to go back and change guidance that was issued under the Trump administration that put a chilling effect on the folks who oversee retirement plans from considering sustainability or climate risk in their assessment of their plan offerings. So when assuming that changes and guidance comes out from the SEC or the Department of Labor rather about how you should and you need to address climate risk in these investment assets as a fiduciary, that means that trillions of dollars will all of a sudden be open to these risks and be allocated accordingly over time. So that's a big deal. It's a really big deal. And then that last one, the federal government is likely going to consider and disclose climate risk in all of its management, purchasing, and lending activities. And, we all know the federal government is big. When you sit down and begin to look at the impact of this particular item, it's really unbelievable. And that lending activities is a big deal. That includes Department of Agriculture, the FHA, all sorts of different lending institutions that once they begin, I see that, Jeff, hurrah. So they're already doing more risk-based pricing of loans. So if you are engaged in a climate risky type activity, or if your house is located in a floodplain, it's all of a sudden you're going to start reflecting the fact that you're going to have to pay more for your mortgage, more for your loans, rather than it just being a general rate that everybody across the country got. And that's just one component of this particular part of the order. The management and purchasing means that the federal government and everything it buys is going to be requiring climate risk disclosure by all of its suppliers, and likely down the road requiring certain actions as well on their part with respect to climate risk.
Can I shoot a quick question in, Lucas?
Yes.
One of the big areas has been the federal government's backing up insurance of coastal properties as well as other properties. And that's been a hot political topic. Will this change that also? Will they have to take risk appropriately into account in backing up insurance of properties?
Yeah, it's my understanding that it will, this is comprehensive enough to include that. And I had seen indications that at least under some bills, even before this was signed, that there were beyond just that, there were equity components to the pricing of insurance as well. So they were reflecting climate and racial equity and income equity components to their pricing. So it is included in here in the scope of this order, but before that, they were already beginning to address it in the ways that they could. So I'm hopeful that we'll see very aggressive action there. These slides have more detail on each of the components, which I think is useful to read at a later date. Oh, and my wife told me that folks might not know what TLDR means because it's a young person's thing. I'm surprised I know. Too long, didn't read. So that's the very short version of what it did there. So how about us? What should we do with this in this new world where climate risk is actually it's actually a factor now? What can we do if we feel that our assets are not being managed with a climate risk aware lens? So here's what you do as an individual investor. Here are some things you can do. If you invest your own assets, you have some mutual funds in your own account. Go ahead and identify more sustainable funds through research into the climate and ESG characteristics of funds. I showed you a little bit of some of those things you can look at up top. There are tons of resources now available online that make it very easy to figure out whether what you're invested in, is more exposed to these risks. Fossil-free funds is a great website. Real Impact Tracker is a really neat one. It's not very comprehensive, but you'll get to see whether or not your funds are creating real impact and not just greenwashing. And then a great resource is also USSIF, the Forum for Sustainable, Responsible, and Impact Investing. They have lots of educational resources, as well as a small, a short certification program. So worth checking out. They're a great organization, and I happen to be an associate member of that organization. And there are plenty out there. I'm happy to try to connect you with whatever resources you might be looking for afterwards. if you have a financial advisor, simply, if you haven't, ask them to help you invest more sustainably. It's not the way it was 10, 15 years ago, where your advisor would harangue you and make you feel bad, like you're an idiot for suggesting that you'd like to invest more sustainably. It's much more common now. Advisors understand that there's viability to it as an investment approach. And there's more offerings too. Advisors feel a little more comfortable than they did 5, 10 years ago. So if you have an advisor, ask him or her to see what they can do for you. Open the conversation. And in fact, there's surveys that show advisors are waiting for their clients to bring up the question, and they won't do more until you ask them that. So it's wise. Go ahead and ask them. And then finally, if you have a retirement plan, this can be very impactful. Speak to your employer about sustainability and climate risk in your retirement plan. We at Greenleaf, we're retirement plan advisors, and we're trustees and record keepers. And we get questions all the time that get forwarded around to the team, and they get our gears thinking. And so it doesn't go into a vacuum when you ask these questions of your advisors. It really does move an organization forward and gets more people comfortable with climate and sustainability risks. And then, so you can speak to your employer, or you can speak directly to your service provider. And then ask for sustainable investment options to be added to the plan menu. With that change in guidance at the DOL, it won't be long until more of these options are going to be in plans, and people are going to feel comfortable allocating to them. And that is it. Oh, this is fiduciary. So if you are a fiduciary, if you're on an investment committee, or you employ people and you have a retirement plan, go ahead and educate yourself on these topics. It'll be a requirement soon. So you might as well go ahead and do it now. And again, I mentioned that USIF certification program. And honestly, in the same way that an individual participant might, ask your financial service providers to describe their approach to ESG and sustainability. Most of them have formal materials around this now, but if they don't, they'll put it together for you. And that is it. Yay. So thank you all for your time today, and I'm happy to answer whatever questions you have, or just chit chat if you'd like.
Hey, let's give him a hand first, whether you do that virtual or both, or we do jazz hands a lot in this group. So, hey, Mark, do you want to go ahead and ask your question? I see Mark Miller was asking about TIA-CREF, which so many of us are Western folks here.
Well, yeah, I put that question in before Lucas got to that point. So skip the detail. It goes to, how do we lean on our employer if it's a big employer like Western, and they have an agreement with TIAA, here's the lineup of funds we have, and there's one low carbon fund in that. So my wife and I are in that, but it'd be nice to have a low carbon bond fund and a low carbon international fund. So I guess how we lean on them is, you just call up the TIAA representative and say, hey, I'd like this. And maybe if it bubbles up enough, but maybe someone, I don't know if we need another committee to those of us who are invested with Western to corporately with the group say, hey, come on, let's have some more. That's it.
Yeah, and that's a good question. I happen to know, because it is a fund that's approved on Greenleaf's platform as well. TIAA has a very solid core plus fixed income fund that is managed with a sustainable investment lens. I believe they consider it fossil fuel free. And it's one that has performed well against other fixed income options. It's one that any fiduciary, and it's the same cost as other funds of its type, any fiduciary should feel comfortable with a fund like that. And TIAA is generally has a number of offerings similar to that across different asset classes. So if you raise that topic, I would be certain they have something that they'd feel comfortable getting into a plan for you.
Just real quick, we have different options depending on whether you're in the retirement plan or an IRA, and they're more restrictive in the IRA and so forth. But that's something we can take up with our individual. Sometimes it's not as easy as when they have one. Do I have access to them?
Yeah. Yeah.
And I know a couple other folks had emailed me that kind of same question because so many of us are invested with them. I'm wondering if maybe we ought to host a meeting with our TA, our representatives from Western, and have some of us meet with them directly and ask them what's going on. But Lucas is right. I know a lot of that has been moved into a sustainability core investment. And many of you will remember Western's own fiduciary. I guess it's been about 5 years, and it was a very, very difficult committee to get Western to think about transferring some of its general fund, but they did move half of 50% into one of the sustainable funds. And every year I ask them for the report on that, and they say, yeah, it's doing better than our regular funds. And I say, well, let's move it all. And they say, not yet. So I will need your help though on both TIA and Western. And just one caveat, that does not include any foundation money. Those of you that know about the big gift that came through this week, Western does not reveal those. Donna, did you want to ask about the healthcare, or was that just a comment? I'm kind of going through the chat here.
Yeah, it was mostly just a comment about how the climate risks in the healthcare sector did not include an increase in diseases, of which COVID is Exhibit A, and Lyme disease, and there are others as well. I just found that interesting.
Yeah, I have to. I'll speculate on that, and it could be that. It's one of those things that would actually fall under an opportunity for them. How much money did the pharmaceutical companies make on these vaccines? I think they're making a pretty penny. And similarly, the increase in I hope I get this right, the zoonotic and exotic diseases, I think generally might bode well for them. Instead of it being something they're worried about. So maybe that's why. Maybe that's why those risks aren't highlighted.
Oh, yeah, but wouldn't the hospitals have a greater exposure and possible losses because of all of the COVID deaths and illnesses? So it's offset. It's there are definite ramifications.
Sure. And I wonder if they're bundled together in the same sector or not here. But in any event, it is interesting. The SASB risks you'll find notable because they might serve as part of the framework for public companies to disclose on a wide range of sustainability risks once the SEC gets around to it. This is the other notable thing, by the way, about the Biden executive order. It was very time bound. All of this stuff that he's requiring or requesting from the federal agencies is supposed to happen in the next 120 to 180 days. And so they're going to be relying upon the hard work of many other organizations and like SASB and other climate activist organizations as the framework for the work that they're doing. And it's very exciting. So you're going to see that SASB's framework will be adopted. And that's all about whether these risks really are material to your average investor when they're trying to invest in these companies.
What does SASB stand for? What's the acronym stand for again?
Yeah, it's the Sustainable Accounting Standards Board, but it just merged with another entity. So now they're called the Value Reporting Foundation.
Yeah, I just want to say one more thing about the healthcare thing before we move on, which is that the other surprise for me is that the third-party payers, the impact on the third-party payers is also seem to be not material enough to include, and I was very surprised about that.
Yeah, that is interesting.
Thank you.
Yeah, I guess I would just frame that, one of the ways that this group would frame your sort of introduction, Lucas, is that the costs of climate change are way more than the costs of any adaptation and those other things we don't even know are coming. And so we do spend a lot of time on that side of it too. I see, Paul, I see your hand. Margie, I want to give you a shout out for putting Green Century in the chat. And I just kind of while we're on this thread of, how clean can I get my money, Lucas? Because when we really looked at this 5 years ago through institutional lenses, there really wasn't only a climate risk fund that we could put things in. And it's still like kind of a gray area for me. Like when we use those screens, are we really, how close do you think we're getting? How good do you think those screens are getting given the sort of risk you presented?
It's really interesting because, it's not very, it remains complicated. It's not very simple. So there are a lot more offerings that are being managed specifically to be fossil fuel free. And so there are more index-based options, but also active investment managers who are stock pickers and trying to outperform the market. There are more decent options out there that are reasonably priced and everything. But that whole question, I've swung back and forth on it a lot over the years about whether or not divesting from fossil fuel stocks makes sense. Morally, sure, it might make sense. But on the other hand, I just saw a big white paper the other day. Well, first, if you're not invested in it, you can't vote on the proxy. So you wouldn't have convinced them to change here. But also green patents. The energy companies produce far more and far higher quality green patents than most other companies that are out there. And they are, and they're being forced to switch their business model. And they have the benefits of being incumbents, having all this expertise, access to capital markets and infrastructure. And at the end of the day, they're going to end up being part of the solution, unfortunately. I don't know how you want to put it. It's unfortunate. Why would we? They've done some horrible things, but so I've begun to prefer active managers personally in the space because they tend to have a nuanced view of the morality and the investment opportunity presented by differing stocks.
Thank you for that. Yeah, Paul.
So Lucas, you started off with like the basic graph from the IPCC about like this much carbon dioxide of the atmosphere and this much heat. And I'm a social scientist, but I dig into some of the science literature. And you may be surprised to hear that even among scientists, there's a lot of diversity of opinion, diversity of findings. And that from my reading, basically, even the IPCC reports that you're reporting from and that everyone has to go from are probably on the conservative side in terms of risk. And the two simple reasons for why that's the case are, number one, the computer models are based on data that they can actually get, which is like from the last 50, 60 years. But the changes that we're seeing, the newer science is finding deeper impacts than the historical data tends to indicate. And the second reason is that the deep history, the paleoclimate history, the last 800,000 years would indicate much stronger climate impacts, climate system impacts from the carbon dioxide and other stuff we're putting into the atmosphere than we're seeing so far. And there's a lot of research onto, well, what pathways are they? And, some good work indicates that, well, actually, sea level is rising exponentially, but the IPCC puts it as rising linearly, which makes a big difference.
Yeah.
So just for fun, the risk that everyone works from may well be on the conservative side.
And when you say conservative, you are saying they're understating the potential damage.
That's quite correct.
Yeah.
And maybe very significantly.
Yeah.
Period.
Yeah. Oh, and that's true too. So thank you for that. There's that whole dialogue around tipping points and what we're seeing about the ocean's capacity to handle temperature increases. The other thing is these models aren't good at innovation. They did not forecast this adoption curve on solar. And so, these are, that one's actually, of course, in our favor. But I'm not one to ever tell anybody to, mystically say technology is going to save us. But there's a lot of uncertainty in these models. Those pathways, the fact that Biden focused on the 1.5 pathway off the bat, which really necessitates significant changes today and not waiting and praying, was meaningful to me. And I thought it was made me feel quite hopeful.
Yeah, Jeff.
Lucas, generally, are you seeing some of the newer, whether startups or newer companies in renewable energy, are they emerging and growing rapidly and taking market share away from the fossil fuel majors, or are the majors buying them out left and right and absorbing them into their changing business models?
Yeah, so it's funny because I don't know what the most recent numbers are, but energy demand just keeps going up and going up and going up. And so while the growth rate of investment in low carbon sources is astronomical, it's still, it's basically keeping pace as a percentage of the total energy mix in lots of cases. And so there are a lot of companies that are growing very quickly. Solar has been an incredible place to be. I don't see, I'm not a very close observer, but I haven't seen a lot of purchases of these companies by the oil companies, but they are all, especially Shell and BP, are pivoting their business models and doing a lot more internally to try to grow new sources. So.
Thank you.
Good questions out there. Yeah, Nikki.
Isn't there also a difference between what the companies, international companies, are doing in the United States versus Europe? My understanding is, for instance, Exxon Europe is doing a lot more with renewables and getting out of fossil fuel, working even with Jeff's nemesis of recycle. And and so isn't there a big difference between their international versus their national positions?
Yeah, so I don't know about the ways, so clearly regulation in Europe is much stronger and further along than it is in the US. But I'm not savvy to the ways that companies split up their operations to try to game it. In general, however, there are some slightly better oil companies than others. And again, BP is one that's been cited as one of the better ones, working harder and working in better faith with the regulators than Exxon, for example. But that's what is so exciting about some of these developments here is that from every front now, they can't hide. Investors care about it. The regulators care about it. And investors care about it whether or not you care about fossil fuels. You care about the risk this company's running because they're putting themselves at legal jeopardy the way they operate. So while it might be different today, I'm sure it won't be too different for very much longer.
I was looking for Ron Kramer on the call, who wrote a book called Carbon Criminals, Climate Crimes. And this is exactly sort of the focus. And I'm really glad to hear, not only from our pressure as consumers, right, but a lot of the really serious litigation that has taken over the last 10 years. And now the investors themselves, right, taking over those companies and knowing that you were going to come and talk us through those things. I think y'all know me well enough to know what I'm going to say is that without government regulation, okay, of this particular sector, we're not going to get there that fast. And Lucas, I actually didn't know. I had skimmed the order. I didn't know that there was that short time frame for the agencies to get those rules in place. And so that will be a huge point of leverage. It's going to come a lot sooner than I thought to be able to have everyone actually listing their climate risk and their exposure. And that will give us leverage personally and I think institutionally. So that's a really, really big deal. And I'm glad you were here to walk us through some of that.
It's great. And what's nice about it too is that though another president could come in and try to dismantle what's occurring here, since these things are, the information itself will have come to light. So that's one thing, but also all the market participants are moving in this direction anyway. It won't revert back to the same dark, the levels of ignorance there were before. So it's, I think most of this order is going to stick and be irreversible. So again, very excited about that.
Well, let's give Lucas another big round of virtual applause. Thank you so much for coming and sharing everything with us today. I learned a lot. I think it was really instructive to see how you, who are at the top of the perch here and doing this every day, how you see that world in the lens of those climate risks and how they're really translated into those investment and financial decisions, and where that shared economy is coming, right? Look at every sector has some exposure, right? So we talk about reimagining all of those different ways that we do everything in here. All right, so with that, I'm going to end the recording officially. Thank you for joining us.